Every major bank on Wall Street has a price target for this asset, and if you're using it to plan around this trade, you're already behind. Not because their math is bad, but because the number they're giving you is already outdated. So by the end of this video, you'll understand the historical triggers behind these supercycles, the three massive catalysts colliding right now, and the framework to help you position your portfolio before the crowd wakes up. And it's not like they're hiding this from you, it's sitting right there in their own reports. They just don't have the right expectations for how fast this moves once it actually gets going. Because this has happened before, more than once. Early 1900s, American cities are exploding, electricity, telephone lines, streetcars, entire urban centers being wired for the first time in human history. Demand didn't just grow, it became the literal infrastructure of modern life. That wave alone helped define this asset's first major bull run. Then, mid-century, Japan, a country flattened by war, rebuilds into the world's third largest economy, averaging 10% growth a year. Into the 1970s, steel mills, shipyards, entire cities rising at once. Same pattern, one economy industrializing at a pace the world hadn't seen. And this asset ran with it again. Then, 2002, China joins the World Trade Organization, and what follows is one of the biggest runs in modern history for this asset class. Prices roughly quadrupling over the next decade as one country's construction boom absorbed everything the world could produce. And I know what you're thinking, that was 20 years ago, ancient history for a market like this. So look at 2020, a pandemic shuts down supply everywhere at once, and less than a year later, trillions in stimulus and the green energy build-out collide with that broken supply. Prices doubled in about 14 months. 4 times in the last 100 years, 4 different triggers, and every single time, it only took one of them. Right now, we don't have one, we have 3. And the asset sitting at the center of all of it, copper. So what are the 3 catalysts colliding on copper right now? Let's start with the one that's already reshaping where it physically moves. Back in August 2025, the US imposed a 50% tariff on certain copper imports under Section 232. Then this April, the administration went further with a proclamation, effective April 6th, expanded that tariff to cover copper articles and derivatives at up to 50% and applied it to the full custom value of the product, not just the copper content inside it. There is a reduced 10% rate, but only if you can prove the copper was fully smelted and cast in the US. Here's what's still hanging over the market though. Refined cathode copper, the actual commodity trading on COMEX and the LME, is still sitting under a separate exemption. Commerce is deciding whether to end that exemption with a tariff near 15% expected January 2027. And you don't need a decision to actually land for it to move the price. Just the anticipation already has. Watch what's happened to US copper inventories. COMEX stockpiles, the US exchange, hit a record 650,000 tons this year, a 7-year high. Meanwhile, LME inventories, the rest of the world benchmark, have been falling toward multi-month lows. This isn't a global shortage, not technically. It's a global market splitting into regional silos, with copper getting stranded on the wrong side of a tariff wall before anyone's even confirmed where that wall ends up. At the peak of tariffs here, in mid-2025, the price gap between US and world copper hit nearly $3,000 a ton, from a tariff that, at the time, hadn't even been finalized yet. What do you think happens to the rest of the world's supply when the US alone is absorbing that much metal? Just in case. Because here's the catalyst number 2, and it's not new, it's just getting worse. It's not theoretical anymore, it's already happened twice at 2 of the biggest mines on Earth. In September 2025, Grasberg, Indonesia, the second largest copper mine in the world, 800,000 tons of wet mud floods the underground mine in minutes. 7 workers lost their lives and Freeport declared force majeure, and the company's own guidance shows production won't fully recover until 2027, a loss approaching 600,000 tons of copper the world was counting on. Same year, different continent, May 2025, Kamoa-Kakula in the Democratic Republic of Congo, at the time the fastest growing copper mine on the planet, a seismic event floods the underground workings. The mine was targeting 420,000 tons for 2026. Guidance was slashed to around 330,000 tons, a roughly 20-28% cut on a mine that was supposed to be scaling up, not down. 2 of the world's most important copper mines, both flooded, both in the same year. And behind both of these shocks sits the structural problem that doesn't go away even after the mines recover. Ore grades have been cut in half over the last 25 years, meaning miners have to dig up more rock for the same amount of metal. Add on top that bringing a new mine online doesn't happen fast, it now takes roughly 17 years to take a project from discovery to full production, then Chile's output, still the largest source in the world, is falling on top of all of this. So tariffs, pulling supply toward one country, two of the world's biggest mines flooding in the same year, and the pipeline that cannot replace any of it for almost 2 decades. And then there's the third piece, the one most people aren't even pricing in yet. Every data center being built right now needs somewhere between 20 and 40 tons of copper per megawatt. That's on top of the demand that was already climbing from EVs and renewables. JP Morgan expects data center copper demand alone to roughly quadruple by 2030. And I know what you're thinking. Wait, didn't we already cover the AI infrastructure story in this channel? We did. The grid crisis, the aging power infrastructure AI is straining past its limit. Turns out the same crisis runs straight through copper too. You cannot rebuild the grid, or the data centers sitting on top of it without it. Tariffs tightening the flow, a deficit that cannot be fixed for years, and the demand curve nobody's fully modeled yet. That's 3 stacked on top of each other at the same time. Alright, 3 catalysts, all landing at once. So what does Wall Street actually say about where this goes? JP Morgan's long-term average target sits around $12,000 a ton. That's about $5.44 a pound. Goldman Sachs, looking out to 2035, calls for $15,000 a ton. Roughly $6.80 a pound. And BMI, the most bullish major forecaster I could find, projects about $17,000 a ton by 2035, about $7.71 for the pound. And here's the part that should stop you. Copper is trading around $6.60 a pound right now. Today, 2026, Goldman's target, the number they expect for 2035, is already within cents of where copper is sitting today. Their decade-long forecast is basically already hit 9 years early. So if their own number is already this far behind reality, what happens when you actually run the framework? Why doesn't it stop where they think it does? Let's pull up the chart. What we see here is the weekly time frame for copper. We are specifically focusing on the structure from 2020, when copper has managed to build an initial 5V move to the upside. We are looking at a 3-wave correction that has already taken place, and at a structure that only sees the momentum accelerating as it moves further. I can quite easily assume this to be a potential wave 1 that had just built from the 2022 lows, and looking at this structure, we can safely assume a wave 3 would follow. Given this assumption, we can expect the wave 3 itself to be an impulse, and to me, the structure underneath it doesn't seem to be setting up to be just a regular wave 3. But instead, I'm looking at this structure to be capable to build a quite extended wave 3, where right before 2026, I believe it just managed to finish its first wave 1 up and the wave 2 correction. Where right now, it's looking at the secondary wave 1 up to have potentially been built here, the wave 2 to follow, and this would allow a wave 3 to take this commodity to much higher prices. How high, you may ask? Well, I'm looking at the ideal target for the white wave 3 to be at the 138.2% extension of the wave 1. That sits right around $11. But if this structure remains true to what I have just laid down here, my expectation would be for it to far exceed those levels. Based on this interpretation, I am looking at this to have been an internal wave 1 up and a wave 2 down here, where right now the wave 3 would be expected to extend quite substantially itself, where the target for the internal white wave 3 is also the 138.2% extension of the wave 1. That alone sits at $9. Then we can go even a step further, because based on this internal structure, I am capable to identify another one too here. This would build the core wave 3, which is typically the strongest wave of any rally. Given this assumption, we can look for the internal target here as well, where it is once again the 138.2% extension of the wave 1, which itself is around $9.35. So technically, we would be looking for this structure alone to reach the target of the overall wave 3, which means the larger wave 3 would be expected to push even further, likely hitting that $11 target we had for the largest degree wave 3 we have been sharing here. This sets up this commodity for a rally unlike we have seen in our lifetime. We will cover the fundamental risks in a moment here, but this sets up the commodity for a bull run unlike we have seen in our entire lives here. And I just realized I'm on a different chart than I intended to be on here, but this structure is capable to generate a rally even stronger than the one we have seen in the early 2000s. Now, with all of this in mind, where do we look to understand that this isn't going to work out, that maybe this is building an entirely different structure, something significantly less bullish? We have two major levels here. The beginning of the latest rally from June. Ideally, it doesn't even get close to them. I would really like to see a lot of strength within this structure. But this is not the end-all be-all of this interpretation. Even if this is not the wave to bottom. Yeah? If it cannot hold $5.90, I would strongly expect, at the very least, for this level to hold. Around $5.20. If it is broken, the thesis is most likely gone. The momentum would have been far too damaged for this to be a likely outcome anymore. Sure, technically we could allow this entire structure to work out as a wave 1 and have a larger wave 2. But the further down it goes, the lower the likelihood of success for the next wave 3 to follow is. So that is why I am looking specifically at these two higher price points to hold for it to still be able to generate the next strong move up. But it is also quite fragile. I'm not too upset about that, I'm actually quite happy because it provides me clear levels where I know I need to start looking for the exit. Now, here's the part that should make you sit up, because Wall Street isn't just wrong here. They don't even agree with each other. If you want proof that Wall Street is completely guessing, look at their 2026 balance sheets. Goldman Sachs is forecasting a 300,000 ton surplus, claiming there's too much copper. Meanwhile, JP Morgan flips the exact same math on its head, calling for a 330,000 ton deficit because of AI data centers. These are the two biggest banks on earth, and they are off by more than 500,000 tons. They don't have a clue because they're using outdated models to track an unprecedented industrial supercycle. You can't make this stuff up. Now, I'd be doing you a disservice if I only left it there. So let's play the devil's advocate for a second, because even with two of the biggest banks confused, are there legitimate reasons to be skeptical? There are actually three. First, substitution. When copper gets expensive enough, engineers start swapping in aluminum for wiring and heat exchangers, and that really does happen. But copper conducts electricity roughly 60% better than aluminum, which is exactly why it cannot be swapped out in the applications actually driving this story. EV motors, data center power distribution, high performance electronics. So the substitution valve is real, but it doesn't open where the demand is coming from. Then the second point is recession. Copper isn't gold. It's not a hedge people run to. It's consumed. Wiring, construction, cars, factories. That's why traders call it Dr. Copper. It tracks the real economy for better or worse. If global growth stalls hard enough, copper can crash. It fell from $8,000 a ton to under $3,000 in the financial crisis in 2008. It dropped again in the 2015-2016 China slowdown. And this is the one honest risk in this entire video that isn't about supply. It's about the broader economy, and no chart can rule it out. Then the third point, a faster supply rebound. Freeport could restart Grasberg ahead of schedule. Scrap could float back into the market at these prices. That's Goldman's surplus case, essentially. Now, here's why I don't think the last one changes the outcome. Even if it is right, even a faster Grasberg restart doesn't touch the 17-year pipeline problem, or the ore grades that keep falling regardless of what one mine does next quarter. A good quarter from one mine isn't a new mine. The deficit doesn't need every mine to fail. It just needs the pipeline to stay this slow, and right now nothing points to that changing. Now, if you want the exposure to this market, there are stock and index options as well, but be aware, these are leverage bets. Names like Freeport-McMoRan or Southern Copper on the producer side, or a basket like the Global X Copper Miners ETF if you'd rather not bet on one company alone. So let's wrap this up, shall we? 4 times in the last 100 years, copper ran on one catalyst. Right now there are 3. Tariffs, tightening supply, a deficit that cannot be fixed for almost 2 decades, and a demand curve from AI that most of Wall Street hasn't even finished modeling. Their own targets are already behind where the price sits today. That's not a bullish call from me, that's just what happens when you actually run the framework. If you don't want to be the last one to figure that out, this is the moment to pay attention to copper. And if you want to better understand the grid story, It should show up on the screen right now. But for now, these are the levels, this is the trade setup. I hope you enjoyed the video, and if you did, don't forget to leave a like, subscribe, and if you enjoyed the content and want to support it directly, check out the channel membership, and I'll see you in the next one. Bye bye.